Hi, this is James Shrug at Westpac with our London end of day report for Wednesday, the 16th of May. Look, sentiment started off the day here in London pretty negative with reports from last night that there'd been a run on Greek banks amounting to about 700 million euros being withdrawn in a short period up to Monday, raising concerns or reigniting, intensifying concerns about the banking system in Greece and the risk of contagion from collapse in the Greek banking system into other parts of Europe. But the mood kind of improved during the session. We had the Bank of England's quarterly inflation report, where a fairly sombre Mervyn King, the governor of the Bank of England, announced a 1.6% inflation forecast in 2 years' time, quite a bit below target, which would normally suggest that the bank would be easing policy further. But he hinted that there was some division on the Monetary Policy Committee, saying that arguments could be made both in favour of further asset purchases or indeed reversing some of the asset purchases that they've already made. Quarterly jobs numbers for the UK were actually pretty solid. We saw 120,000 jobs added in the first quarter, on top of a decent gain in the fourth quarter of last year, although not enough together to reverse the big decline in the third quarter of last year. Those figures actually contrast with GDP numbers, which showed contracting output in the fourth quarter and the first quarter, adding some weight to the view that maybe we're going to get at least an upward revision to the latest quarterly figures, which, as I say, on GDP showed a contraction. We had some decent US numbers today. Housing starts bounced 2.6% in April. Industrial production was up 1.1% in April. Both those numbers reversed declines in the previous month. We've got the FOMC minutes to their meeting back in late April coming up in a couple of hours. That's the next US trigger point to watch for. But the main point, I suppose, to make is that just an hour or so ago we had the ECB's Draghi basically say, we're sticking to our rule book. I mean, it's not our job to make sure Greece stays in the euro. We have a strong preference that they stay there, but we're not going to compromise on our price stability mandate, and not going to compromise our balance sheet either. Not exactly clear why he said that. He could be trying to pull in some of the European Central Bank's governors, I think including the Portuguese and the Irish governors recently, who have talked a bit more openly about Greece potentially leaving the euro. He could be trying to get them to toe the line a little bit. And it could be just a bit of a shot across the bows too, hoping that the Greeks, with an election most likely now to be held on June 17th, risking everything, one could argue, if they don't vote in an administration that's prepared to stick with the austerity commitments previously agreed to. But it's difficult to see how that's all going to end up. We've heard that the ECB's frozen lending to various Greek banks because of concerns about their capitalisation. We had the payment by Greece yesterday of a 436 million euro maturity, a 10-year note maturity, to creditors that didn't participate in the restructuring, that saw most creditors wear something like a 75% haircut. That's created the moral hazard that any future restructuring of Greek debt, even if it were to be allowed, and if other European countries, Germany included, were to be a little bit more generous in their support of Greece in exchange for yet another restructuring, it might be harder to get that restructuring actually agreed to, given that Greece did actually pay those that held out from the last restructuring. So it's all a big mess in Greece. The risk of contagion to other parts of Europe is right at the forefront of everyone's minds and trading at the moment. And certainly towards the end of the session, markets in Europe were heading back into negative territory. I'll give you some numbers there. The FTSE down 0.6%, just heading into the close. Banking sector and commodity stocks in particular leading the declines. The other European markets are all down, with the exception of the French market, up 0.3%. Germany down a quarter, Spain down 1.3%, Italy down 0.2%. The Dow was up about 90 points at one stage. It's up 43 points as I'm speaking, or about 1/3% at 12,675. The positive data helped the US market somewhat, but the European concerns or Greek concerns are certainly weighing on the market as I'm speaking right now. In commodity markets, as I mentioned, commodity stocks were down today. Commodity prices are down. Copper's off 1.3%. Oil's down 1.1%, and looking at a 1% loss on the gold price too. Oil's at $92.95 a barrel. Gold's on $1,542 an ounce. The Aussie dollar, it's at 99.3 cents at the moment, but it did spend much of today actually with a 98 big figure, trading below 99 cents. So the Aussie dollar very much suffering from the risk aversion that's gripping markets at the moment. Interesting comments from Ken Henry on the ABC 7:30 report last night, where he thought that the Aussie dollar could actually benefit from safe haven status. That's an interesting viewpoint. It doesn't seem to be what's happening at the moment, and I would argue that actually a weaker Aussie dollar is probably helpful in the current environment, given that global growth concerns, global growth expectations are being wound back, commodity prices are falling. A weaker Aussie dollar actually helps cushion the blow from that for the Australian economy. All right, that's something we can argue about though till the cows come home. It's time for me to go home fairly soon, so I'll sign off there for today. Okay, back tomorrow.